Hello and welcome to our annual program in which we dive deep into really what I think is the brilliant mind of Ruchir Sharma. It's a show that gets more attention, more comments and more response than most other analytical shows that we do. And what's more, millions of people say they find the content very useful in their lives, their decision making on what to do and what not to do with their saving and investment in the year ahead. Ruchir Sharma is a brilliant author of several books that have hit the top of the New York Times bestseller list, and he also has his day job. He is responsible for investing funds in developing countries or emerging markets. I can't tell you the exact amount of dollars he controls. He never tells anybody. He's too modest for that. But let's say it's over $20 billion. 20 billion. And that may be a terrible underestimate. I just don't know. Whatever. Ruchir is one of the most respected minds and investors on Wall Street. And he invests outside America in emerging markets. Once again today, Ruchir will look at the year ahead and give us forecasts of the top 10 trends of 2021. Now Ruchir, before we start, can I just ask you, this has been a traumatic year, a complete shock out of the blue. How does this crisis compare with 2008 and 2001? Is this worse than that, or about the same, or better? Not as bad?
Right. I think that to put this in perspective, in terms of the sheer economic effect, because we're discussing that on this show primarily, the contraction that the global economy saw this in 2020 of -4% was the worst contraction in 75 years. So definitely the economic consequences and the economic effect of this has been the worst that we have had in post-World War II history. Now, Time magazine went to the extent of calling this the worst year ever. I'm not sure I would go to such an extreme because I think that history is better remembered than it's lived. The Great Depression, the World Wars, even the 1970s when we had stagflation, Vietnam War, riots, and even in places like India, the emergency. We have had some very difficult periods, but yeah, this ranks right up there in terms of obviously the number of people who have died because of the pandemic, and in terms of economic contraction, that's the one data which will stand out, that this has been the worst economic contraction in 75 years. But again, as your favorite expression is, but as your favorite expression is that it all depends who you ask, because if you ask people who have been involved with the stock market and in the financial community, they've had a very different view, I think, because 2020 ended up being a pretty good year if you were a financial investor and almost did nothing and sat through this crisis.
Actually, that is the most shocking part, and now I know why you're smiling right through the last few days and this show. I mean, just now, Ruchir, don't smile through the show. Okay?
Okay.
Let's get to okay. Let's get down to your first of your 10 forecasts. Now, this is just what you were talking about. That has been a terrible year for a very contrary year. If we look at the #1, the first big trend that we are going to look for, we're going to look towards the opposite of 2020. We're going to see a surging economy, Ruchir, and a sluggish stock market. Now by that we mean, if we move on to the actual figures, there is this great disconnect. And the disconnect is really startling in 2020. What you were just talking about. This is all your data, Ruchir, which I'm trying to simplify. So please forgive me and interrupt me if there's anything wrong. But in 2020, the global economy tanked, but the stock markets boomed. And let's have a look at how how contrary they were. The world GDP fell by 4%, as you just mentioned. That is huge. And the world stock markets went up by 13%. You'd think that the stock markets would care about the poor and the dying, but no, up 13%, and I'm going to ask you why. And what about India? You know, it's just exactly the same. If we look at what happened in 2020 in India, the disconnect is even more dramatic. India's economy plummeted by 8%, but stock markets boomed almost as much, -8 on the GDP and +12%, Ruchir, on the stock markets. That's a real shocker. Why India's GDP plummeted so much? If we look at India's fiscal stimulus was low, and you can see that the fiscal stimulus in India, these are all your figures, Ruchir, 2.2% compared to the average among developing economies of 4.7%, and developed of 8.5% of GDP was fiscal. But India's monetary stimulus of two types was high. If you look at monetary stimulus direct, 6% in India compared to just 1.6% for developing economies on average. Of course, the developed 14.2%. And finally, if you look at credit stimulus like guarantees, loan guarantees, etc., India very high, 7%, while the average for developing economies 1.9%, and for developed, of course developed is in a different league because they can afford it. So finally, I mean, just look at one summary of what you've done, Ruchir. 2021, will the stock market be buoyant still? No, you're saying. The growth in 2021 will be the mirror image of 2020. The economy will bounce back from -4 globally to something quite positive, but the stock market will not be 13%. It won't be so buoyant. Just explain this some more detail, but don't go above my head. Huh? Please be respectful.
Right. So first, all these numbers that I'm talking to you are in dollar terms and for the calendar year,
right,
which is 2020 and then calendar year 2021. Now let's step back and see why did we see such a great disconnect. In fact, never before in economic history have we had such an instance where the economy has contracted and the stock market has gone up by this magnitude or even gone up at all. Why we had such an instance? And I think there are three reasons why this happened. One, as you pointed out, has been the incredible amount of stimulus that governments and central banks across the world have put in effect this time. In fact, by some estimates, the total amount of stimulus that the governments put to effect for the 2020 crisis was around 5 times larger than what was done during the global financial crisis of 2008-2009. So a massive increase in the stimulus, not just in the US and developed economies, but even places like India and other emerging markets, especially compared to 2008-2009. So when you have that much amount of stimulus, you're really protecting a lot of people. But in this crisis in particular, given the nature of this crisis, a couple of things happened. One, a lot of people were just sitting home, and when they were sitting at home, they were not spending that much. And a lot of the stimulus money went straight into their bank accounts. The savings rates increased, and you had a lot many more people using that money to play the stock market or to invest in the stock market. So a huge amount of stimulus, some of it finds its way into the stock market through this channel where people's savings rates go up and they're not spending as much because they're sitting home, they're not being able to spend on travel, leisure, other items, and that extra savings is making its way into the stock market. The other thing I think is that the markets do tend to be a bit anticipatory. And I think that what the markets were doing here was saying that this is going to be a one-off, it's a one-time big hit, but there's nothing structurally wrong with the global economy, and the moment a vaccine comes through, people will get back to normal and a sense of normalcy will return. And in that regard, you can argue that the markets did have better foresight than a lot of pessimists who were feeling very bearish about how long this could last and what would happen. I think human ingenuity in coming up with the vaccine has been pretty remarkable this time. as we have seen the efficacy rates that have been published for the vaccine being very high. So the markets have been looking a bit ahead, and they are forecasting that this is a one-off event, and in 2021 things will get back to normal. There are all sorts of projections as to when that could happen. In countries like Israel, as you know, that we've already begun a very aggressive rollout where nearly everyone above 60 in Israel has already been vaccinated, and in places like the US, people think that by the summer you'll pretty much hit rates of 60 to 70% of herd immunity because of the vaccine, and people have already been infected. So I think that it's that foresight that markets are showing here. Now in 2021, I think it's the opposite, right? That the economy surges back because of the fact that you have people just with so much pent-up demand because they've kept away these savings, they've kept away all their habits, and now they want to put that back into motion. So you have a lot more spending in the real economy, but not that much money left to put in the stock markets. And also the stimulus that the governments have put into effect, you don't get that kind of stimulus that you got in 2020. And the third reason, as I said, is that the market has already forecast what's going to happen. So it's already priced in a lot of the good news which may come in 2021.
Right. Actually, that is a really, really interesting forecast that you're making, that the stock market will not be as buoyant this year. That's a big message to everybody. You're not saying it's going to go negative or anything. You're just saying it won't be up to 13%. But have the markets, and I won't say this again, the markets take into the fact that Trump won't be, finally won't be president? Maybe that will make it bump up again. So no, seriously, it's a major forecast, but you're not saying negative. You're just saying not as upbeat, not as much as 13% perhaps, right?
Yeah, I'm trying to say that the very factors that propelled the stock market to do so well in 2020 in the midst of this devastating pandemic, those very factors now go into reverse. So unless something else happens, which we don't anticipate at this juncture, to expect that in 2021 the economy will surge back and the stock market will keep doing well, I think is a bit of a disconnect. So I do think the fact is that interest rates also may go up in terms of, or the liquidity conditions may not be that abundant, something we'll discuss in the subsequent segments in the show. But I think that it's very important to analyze why did the stock market do what it did in 2020 and how those factors will not play out in 2021.
Right. That is really fascinating, and that kind of mirror image you're talking about. Let's quickly move on to the second trend that you are looking ahead in the top 10. One, we just saw the mirror image. The second is you're saying inflation after many, many years could come back again, set to rise. Now by that you're looking at the trends so far. If inflation is set to rise after 20 years of low stable inflation, you say, could prices rise in 2021? Just look at that. This is global inflation from your data. It dropped from around 15% in 1990, for the last 20 years averaging around 2.8%, and now it could come back again. That is an important factor to take into account in anybody's planning. And what are the reasons for inflation returning? You mentioned 4 Ds. One is depopulation. You're talking about labor shortages. The 4 Ds we're talking about. The second is deglobalization, especially when Trump was there. There's declining productivity, which means higher costs. And the 4th D is debt, so much money being printed. So these are the factors, Ruchir, that you're saying could lead to a slightly worrying fact that, and everybody must take this into account in their planning, that prices may start rising around the world again.
The surest way for an economist to get discredited is to talk about higher inflation because that's been such a losing forecast for the last 30, 40 years.
Right.
Really, since the 1980s, you've had lower and lower inflation around the world. Many people keep calling for higher inflation. It just never seems to show up. But I think that what's happened now is very interesting. One, that in 2020, despite such a horrible economic contraction that we got in the global economy, inflation did not fall that much. It fell, in fact, even less than compared to 2008, 2009, when you had the global financial crisis. And I think there are some structural changes which are underway in the global economy. The same structural changes which kept inflation so low for so long, I think are one by one slowly beginning to reverse itself. Why was inflation so low for the last 30, 40 years? One was because you had this incredible era of globalization, where much more competition was entering the global economy. More and more people were joining the global workforce, more and more goods and trades and services, everything was booming in this era of globalization. That's changing. Many governments around the world are becoming more protectionist. Also, the population growth rate is slowing down, and you don't have so many new people entering the workforce as you did with China, India. Even in these countries, the population growth rates are slowing down. In China, in fact, the working age population growth rate has now turned negative. And then this entire factor of more and more government involvement in the economy has led to lower and lower productivity. So something which is also, I think, likely to lead to higher inflation going ahead. And the most important factor which I mentioned is just the incredible amount of stimulus that has been put to work this time. The order of magnitude is so great, and even though the stimulus effects will begin to fade in 2021, there is no appetite amongst policymakers to do anything to withdraw the stimulus or to tighten. So I think that these factors could slowly contribute to inflation bottoming out and to inflation rising. Now, these are very slow changes. It takes a long time for this to happen. Remember, inflation peaked in the global economy, as you pointed out, in 1990, in the US even before that. But it took 10 or 20 years for people to really appreciate that trend. I think that similarly now, these are the very incipient signs that inflation could begin to rise, prices could begin to increase. We will go through in the subsequent segment how commodity prices, which have been so low for such a long period of time, could contribute to higher inflation. But I think that this is something which is there. The seeds are being sown for inflation to gradually begin to turn higher across the world after this extraordinary period of very low inflation.
Thank you for saying that I pointed out. I am just using your data and just describing the graphics. Now, you talked about global, but let's just look at India, because you even look at whether inflation will come back to India. And yes, India's inflation is likely to get worse. First of all, already it's worse. Global ranking of India's inflation is worrying. Up to 2010, we were 88th worst in the world. In the 2010 to now, we are 140th, Ruchir. That is a huge drop. That's almost at the bottom of the worst record inflation that India's got around the world. And you're saying that could carry on.
Yeah, I think that this is a worrying sign for India, that why is our inflation so sticky? That yes, inflation today is not as high as it was 5-7 years ago when we had double-digit inflation. So that has been brought under control. But remember that globally inflation is very low, and India's inflation rate continues to be about 3 or 4 percentage points higher than the global average. And that is something we need to think a bit harder about. So the rankings, that's what they show, that of the 180 odd economies in the world today, India's inflation ranking is at 144. And I think this has to do with the fact that India's growth model over the last decade has been very much driven by more and more consumption and not enough investments and savings. And this very consumption-oriented economy is something which has contributed to higher inflation. So yeah, inflation is well off its peak in India, but it is still 3 to 4 percentage points higher than the global average. And in fact, among the major emerging markets, India's inflation rate is the second highest, behind only Turkey. So this is something which we need to think about, and possibly a reason why India's central bank may have to start raising interest rates faster than, let's say, other central banks in the world, and possibly as early as the second half of 2021.
It is worrying and very important to take into consideration in anybody's planning in their lives. But the first implication of this you immediately come to is that it could affect interest rates. Let's have a look at your third trend, top trend, and among the top 10 trends, the third. Inflation, we said a surging economy, a sluggish stock market, inflation set to rise, and your third is, therefore, interest rates could go up. Let's have a look at how much you think they could go up and when. Basically, the rise in inflation, you say, means interest rates may also rise. If inflation rises, interest rates will follow and will begin to rise. And this is the trend by your data. India's interest rates were really high until about 2018 and then dropped, but of course still above global levels, which have always been lower. But interest rates in India have come down quite considerably. But now you're saying that in 2021, because of inflation, interest rates may start going up again. And that is a key factor affecting savings, affecting whether you buy property or not, and various other factors. If we move on, how this is going to happen and the impact of it, higher interest rates also means that share prices will no longer be booming. Higher interest rates bad for the stock market. First of all, the impact of higher interest rates. In the 80s, the stock market wasn't that big compared to GDP, according to your data. It was about the same size. The value of GDP, value of stock market. Now, the value of the stock market globally is 4 times the value of global GDP. That's just a huge change that you point out. And you feel that with higher interest rates, that 4x may come down. GDP will go up, but the stock market won't be 4 times or may not be 4 times as high as the GDP. It is a major statement, Ruchir, a major finding, I must say.
Yeah, I think that over the last 30 to 40 years, the biggest beneficiaries of lower and lower interest rates, and by some measures, in fact, nominal interest rates around the world today are at 5,000-year lows. Like your Bank of England, other people have tried to do data on this going back centuries, and this is the lowest interest rates have ever been. In fact, today, you have $18 trillion or 27% of all investment grade debt today in the world has negative interest rates, like around the world. So it's just unprecedented in terms of what's happening. Now, one consequence of this is that a lot of the money has flown into financial assets, stocks and bonds. So as you point out, that today the value of the financial economy, which is mainly stocks and bonds, is 4 times larger than the value of the underlying economy. And this is a major reason also for rising wealth and income inequality, because the people who own these financial assets tend to be the rich, even in places such as the United States. About 80% of all the stocks there are owned by the top 10-15% of the people in that economy. In India, it's even more extreme. So I think that they have been the big beneficiaries of this incredible stock market boom that we have seen, underpinned by very low and falling interest rates. So if you begin to get a turn in interest rates, and particularly in long-term interest rates, I think it will be difficult for the stock market to keep doing as well as generally it's done around the world. Now, as we'll discuss in the subsequent segment, I think emerging markets such as India are better poised to deal with higher interest rates, because I think that emerging markets are much more undervalued, cheaper. But in general, for the global economy and for global financial markets, if interest rates begin to increase, a very powerful tailwind that has propelled stock prices higher turns into a headwind.
Yeah, Ruchir, just to simplify and make it a little clearer for ordinary folks like me, if interest rates are going up, that means I will get higher returns for my savings, but I'll also have to pay, if I have any loans, I'll have to pay a higher interest every month or whatever for loans, but I will be encouraged with higher interest, higher returns on my savings. Is that right? That's the impact of interest rates also on an ordinary person?
Yes, that's correct. That's exactly the impact. Now, of course, we have to take into account that if inflation also begins to increase, will interest rates rise faster than inflation or less than inflation? So that's to take into account. But the way you put it is exactly how it is, that that's what we are. And I think that anyone needs to think as to what is the inflation adjusted return that they will get on their savings to know that what's the best place to channelize your savings.
Ruchir, I'm very glad you said that, and please keep saying that. Whenever I say something, please say that is correct. You've put it absolutely correctly. Please always say that. Don't ever say that I've said something wrong, okay? But moving on to your fourth. Now we've seen the first three. Surging economy, inflation set to rise, and it's also the best time to buy property. And if you buy property, you should buy it at a fixed interest because they're likely to rise. Now, to buy property, why is it the best time to buy property? Let's have a look at your data. It's the best time to buy property in India because homes, according to you, are at their most affordable ever in India. Just look at that data that you've got. If you look at the price of property relative to incomes, it used to be 5 times, but now incomes have been rising faster relative to property, and now property is 3 times, and that's a huge change. And if we look at the implications of that, in India property prices are falling, globally property prices are rising. And if you look at that graph of yours, in 2018 at about 10% it was rising. Now property prices are averaging negative, while globally it never rose as fast as in India. In 2018 it was at 3%, but then it fell, and now it could go, property prices globally could rise. So it's a real indication that for India there's a comparative pressure of advantage of buying property now. Could you explain why this is happening, Ruchir?
Yeah, I think India in this way has had its own cycle. As we know that there was a big property boom in India in the late 2000s. It led to a massive amount of oversupply, and then also you had all sorts of problems which came up in the real estate sector, and there's been a cleanup operation which has been going on for a while. There have been massive regulatory changes which have taken place. As a result of this, what we have in India is that in the last few years, property prices in India really, as it shows, have gone nowhere, yet people's incomes have kept going up. So now it's become much more affordable for people to buy homes. This is the most affordable that it's ever been to buy homes, and I think it's also a great time to buy a home taking a fixed rate mortgage because interest rates are likely to go up over the next few years, I think. And so if you can lock in a fixed rate mortgage, which banks typically don't like giving, but you can try to get that, especially for the first few years, they'd be happy to do it, I think. I think that this is a great time to buy a property in India, and also links to my earlier trend. Across the world, what we have seen is that property does well as a hedge against inflation, that when inflation goes up, typically property prices tend to do well. So I think that if inflation does begin to inch higher, as I have suggested, that's another reason for buying property. So this is a place where a lot of people still don't own a home, and the affordability metrics now are nudging them to buy a home. And in the rest of the world, we've already seen that after the housing bust of 2008-2009, it took a while for things to recover, but home prices from China to the United States have been surging over the last few years. And I think that India too could join this trend in the years ahead.
Very, very interesting. All very operational points for all of us to actually pay attention to. Moving on to your fifth, and I find this also quite a shock actually. What you're saying in your hashtag 5 in the top trends of 2021 is that the dollar, which dominates the world, may not work out. Let's have a look. We've had, of course, just talked about the best time to buy property, but we could see the decline of the US dollar. Now, what do you mean by that? If we look at your data now, it looks something like this. And this is really, really fascinating, that there have been these long periods where different currencies have dominated the world. And you're obviously both a historian and a financial and an economist. 1450 to 1530, 80 years, Portugal dominated in terms of the global reserve currency. Then Spain for 110 years. Then Netherlands for 8 years. I didn't know all this. Then France, the French currency was the global reserve for 95 years. And then 1815 to 1920, it was Britain, the British sterling, that dominated the world in terms of global reserve currency. And then for the last 100 years, the United States has, the dollar has dominated and become the global reserve currency. But as you can see, the average is around 94 years, and USA is just already at 100. So going by history, what you're saying is that that could change, and it may not last much longer as the global reserve currency. And moving on from that, actually, your other data that kind of supports this. Why should the US dollar lose its dominance? Is because the massive printing of the US dollar in 2020. It could printing too many dollars in 2020 threaten the US dollar as a global reserve? You're saying that in 1990 to 2000, those 10 years, the US printed about $500 billion per year. Then in 2000, if we move on to 2020, those 20 years, America was printing new dollars of $1 trillion a year. And in this year, we printed $5 trillion. That's 5 years average of the last 20 years, and the entire amount printed in 1990 to 2000. That is phenomenal. 5 trillion, Ruchir, in just 1 year. So what does this mean? I mean, it sounds a bit kind of distant, but you brought it down to what is an alternative one could possibly think of? A booming Bitcoin, could that be a possible investment, and should one look at that as a possible change? Because this distrust, you say, in the US dollar is boosting Bitcoin and other cryptocurrencies amazingly. And if we go through each point, the Bitcoin market, you say, is now 700 billion. It wasn't long ago. That value was like up 300% in 1 year. Nothing has gone up that fast. And if we move on, volatility, which always was terrifying about the Bitcoin, up, down, that key problem, you're saying, is now coming down. And more and more people are accepting payment by Bitcoin, which was a real hesitant earlier. And interestingly, young people in their 20s and 30s, 27% of that, is almost 1 in 3, own Bitcoins. Above 55s, only 3%. So, almost 1/10. It's a new thing which young people are taking up. So it could be a whole new trend now, and that could continue into 2021 and onwards. Is that what you're saying?
Yeah. I think the data here for me is very fascinating, because 20% of all the dollars that are circulation in the world were printed in just 1 year, 2020. The issue is that many of the central banks have also been printing a lot of money. Now you take the Indian Central Bank, nearly 10% of all the rupees in circulation were printed in just 1 year, 2020. So many central banks have been doing this. Now historically, as that graph of mine showed, that when one currency would become very extended, there'd be too much central bank printing of that currency, and that country would take its reserve currency status for granted. Some new alternative would emerge in terms of a different currency. The problem today is that because all central banks have been printing so much money, particularly in 2020, something different had to come up. Nature abhors a vacuum. Something different had to come up. And cryptocurrencies, as they are called, with Bitcoin being the leading example, is emerging as some sort of an alternative. Now, I know there's a lot of speculative mania around Bitcoin, and the price has doubled over the last month, which makes me a bit wary about how fast this is rising. But this is a shot across the bow. It's telling central banks around the world that if you keep printing this much amount of money, there will be consequences, there will be growing distrust in currencies, and there will be a yearning for an alternative. And that's what explains this massive increase in Bitcoin. And I find this generational gap to be stunning, which is that a lot of the older people dismiss Bitcoin as being some speculative tech investment, whereas the young people are much more passionate about it. Like for them this has almost become a tool, like a populist revolt against government, against too much government interference, too much government printing of money. So it's almost become like a populist revolt of investing in something like Bitcoin. So I think that this is significant. I'm not sure that Bitcoin is the final answer, but something is coming up to tell you that there is growing distrust in the traditional currencies such as the US dollar. And also I think that why Bitcoin is doing well is because its supply is limited. It is decentralized. There's nobody out there like to completely control it. It's very decentralized, and its supply is limited, which is what makes it a store of value. So the older generation still likes to buy gold because gold is in fact a theme we spoke about last time, and gold did do relatively well over the past year. It went up about 25% or so, but nothing to beat what's happening in Bitcoin. So in many ways Bitcoin is emerging as the new gold for many investors, as a new store of value.
Amazing, actually. Amazing that you connected the distrust with governments and the printing of money and the fact that Bitcoins just can't be printed. There's a fixed supply and people are shifting. Really, really interesting, because 5 years ago Bitcoins, oh, that's wacky. Now it's real mainstream, $700 billion worth. Wow, that's amazing. Moving on to your sixth point, your hashtag number 6 of the top 10 trends. If we look at that, we saw the decline of the US dollar and what it meant. Now you're talking about there could be a revival of commodities. Now commodities, you mean oil, you mean steel, you mean that sort of those sort of things, some minerals as well. And if you look at your data on commodities, it's really interesting. They go in this boom bust situation. So every time there's been a boom in commodities, there's been a bust after that, then a boom, then a bust, then a boom. And the last 10 years has really seen a real decline or commodity bust. And if it goes by the pattern of history, you see the dotted line on the extreme right. If it follows history, it could be commodity boom time again. Really interesting to see that you unearthed this pattern over the years. Now, so you're saying commodity prices could rise in 2021. You're also saying that historically when the US dollar weakens, commodities prices rise. And that's another pattern that you unearth with your data. That's been the US dollar up and down since 2000. And what happened with, and this is even goes back earlier, and look at commodity prices. When the dollar went up, commodity prices down. When the dollar went down, commodity prices up. And so on. And what is happening, if the US dollar keeps going down, you could see, if the same pattern of history continues, commodity prices going up. And that could be good news for emerging markets, because a lot of commodities are produced in emerging markets, you say. So supply shortage of commodities are also going to affect the price. If you have listed a few commodities where you're forecasting supply shortage. If you look at even in agricultural areas, agricultural prices, soy is going to be a 10% shortage, cotton a 2%, and sugar just over 1%. These are not, they look small, but they are significant. And supply shortage in oils and metals, that also may go up. Gas, there's going to be a 4% shortage, crude oil a 2% shortage, and copper almost a 2%. So Ruchir, both the shortage and the dollar falling and the history of boom bust, amazing combination of factors that could be a revival of the commodity market. Is that what you're saying?
Yeah, now this is something which I've been very bearish on. In fact, we have done this show for many years, and at the some of the earlier shows I would always speak about why I don't like commodities, because that long-term chart is so instructive that if you look at the chart the last 100, 200 years, commodity prices have really done nothing They tend to just go up and down, but it's punctuated by these cycles, and I think we could be at that very important juncture just now. And these cycles are the same thing, which is that when you have low commodity prices, people cut their supply, and eventually that leads to shortages, and when demand revives, it leads to a big increase in commodity prices, something we saw in the 2000s. Not every cycle may be as powerful or play itself out in a similar way, but I think that the seeds are again being sown for commodity prices to do well in the years ahead because of the way the supply has been cut after an extended period of low prices, and demand is showing some signs of coming back. And of course, the dollar weakness is something which has always been conducive for commodity prices doing well because they're all denominated in the US dollar. So yeah, I think that this is a major change in view because a decade ago we were saying the opposite. My entire thesis back then was that commodity prices are set to go bust, and therefore I was very bearish on many commodities, including oil, and on countries that produced a lot of these commodities, from Brazil to Russia. And now, a decade later, I feel very differently, thinking that a lot of the supply has been cut from these markets, and so therefore it could be a better time for commodities in the years ahead, with a weaker dollar being a propellant of higher commodity prices.
Wow, really, really significant. And if we move quickly on to the 7th of the top 10 trends, and that you're saying could be a bit of good news for India actually, that the developing countries, after the commodity revival, developing countries could see a comeback. And why is that? If we look at the factors that you're mentioning, there are many positive growth impetus factors. The pandemic inspired digitization, and it's spreading fastest in emerging countries, emerging economies. So look at the expected annual growth rate of digital revenues in India is very high, higher than the average of emerging markets. 13% annual growth rate in digitization, revenues from digitization. And developed markets, the advanced economies, only 6%. That is a huge, huge change and a big boost for developing countries. And then your favorite, and if you could just go through this with us, this crisis-inspired reform, what you call the cycle of life. It's a silver lining of the pandemic, you say, Ruchir.
Right. So if you look at the history of emerging markets, including India, Prannoy, what you see is that we only tend to carry out any economic reform when we have our back to the wall, when we think that we are under siege and we have to do something to get out of trouble. So that's been, and this pattern in India has happened almost every 10 years, right? Since that we've had some sort of a crisis, whether it's global or local, to deal with roughly every 10 years, going back to the early 1980s when we first went to the IMF, the early 1990s when you had the major economic reforms, in 2000, 2001 following the tech bust, then of course in 2011-12 when you had the massive inflation and currency depreciation, which led to the 2013 onwards corrective measures that India took. And now similarly, I think it's very important that in this crisis it again showed that to get growth going we need to focus more on carrying out economic reforms. So that's what we're seeing across many emerging markets, also because, as we showed at the outset of the show, that many emerging markets just don't have the financial wherewithal to spend on stimulus the way the developed economies have. So you have much greater push for carrying out economic reform which will drive productivity higher and therefore lead to much higher economic growth. And of course the problem with many emerging markets, including in India, is that when you end up getting economic reforms, you end up getting a revival. That revival sows the seeds of complacency, and then you end up getting another crisis, and so therefore the advance is stalled. But at least for now, the silver lining of the pandemic is that whether it's Indonesia, Saudi Arabia, UAE, all these countries, Brazil, they're all carrying out economic reform to try and revive foreign interest and foreign capital to come back into their country. And this is something we are seeing as far as India is concerned as well. I find it quite fascinating here that like even in India, there's such a big disconnect between how foreigners perceive the country and how the domestic businesses do, that in the last year, India attracted $23 billion of foreign investor flows, and that was the second highest for any emerging market after China. So I think that, it's to try and sort of get more foreign investment. You see much more efforts being made now because of the crisis that the economy had to endure. So this is a major reason why I feel better about emerging markets today, because a decade ago we all had become too complacent after the growth boom. And the second reason also, which we pointed out there, the digitization that's taking place in places like India and in other emerging markets. And remember, this is a very important point, which is that so far a lot of the technological advances have happened in the developed countries. The US has obviously been at the leading edge of that. But what we're seeing now is that these advances are spreading to the emerging markets as well. And in fact, emerging markets are better at adopting new technology compared to the developed countries, because they don't have legacy issues. There are many people in India or in China, that have never had a bank account, so they can move directly to a modern payment system rather than being wedded to having a bank account and using a bank account for transactions. So not having a legacy infrastructure means that you can do much more new technology without the burden of the past. And so therefore we're seeing the digitization and digital revenues rise much more sharply in emerging markets than in the developed world, which is a big boost for emerging market growth rates in the years ahead.
And you make a distinction very connected to revenue growth from digital payments and digital transactions. Is the digital kind of revolution, that's your 8th point. If we get to your 8th of the top 10, the 8th point is that, okay, we're seeing a developing country come back, but we're also seeing a digital revolution spreading rapidly across the world, and that's going to have a major impact. If we quickly go through these trends, the 8th big trend, the digital revolution, China is really leading the way, and it's a big surprise. 8% is their lead. Korea is about 5%, Japan around about 3%, and India around about 2.5%. These are the kind of top countries where you're seeing digital revolution taking place. This is the percentage of their GDP that depends on that. And if we move on, emerging markets are ahead, but what is interesting is that the digital revolution is still young, so there's a lot of potential still. Previous revolutions have lasted 50 years on average, and the digital revolution, especially in developing countries, is only 10 years. If we look at that, it's, ICT is information, communications and technology. It's really 2010 to now. And look at the other big revolutions that have taken place. They've lasted 50 years, the age of steel, the age of oil, the age of steam, and the industrial revolution. So there's still a lot of potential there, Ruchir, you're saying.
Yeah, and I think that the most fascinating story here has to be China, because just look at how big a role the digital economy now plays in China. This is an economy that I was very worried about because of the incredible amount of debt that China had taken to keep its growth going. But the big surprise in the last 3 to 4 years is just how China has climbed up the technology ladder. So if you go to China today, or at least the last time that I was there before the pandemic broke out over a year ago, it is just fascinating to see in terms of that robots serving you drinks in restaurants is a very real experience in China. Drone delivery of goods, all this is happening out there, and they've moved to a completely cashless society in all the major cities. So China has really shown that you can keep aside the old economy and build a new economy based on technology, and other emerging markets are increasingly following that lead in terms of upping their digital game. So I think this digital revolution is still young in emerging markets. You have many new companies that are rising to play that game, and China has been at the leading edge of it. But even in India, I think that a lot of the growth prospects, a lot of the optimism has to do with the increased digitization that we are seeing in such countries.
Yeah, actually that's just the point that you just mentioned is your next point, the 9th of the top 10. We've just been through the digital revolution that's spreading, but now you're talking about the rise of new challenges. So, we see Google, Facebook, we see all these big companies, but you're saying generally don't expect that they could last because new challenges are likely in the digital world. The best companies of one decade tend to perform poorly in exactly the following decade. If you look at the top 10 stocks of any decade, they would grow at over 2,000% in a decade. And the next decade, they would fall to just 65% growth. That's a dramatic change. And if we look next at the companies, the current top 10, you think, oh, they're all going to be around. But none of these, except for one, Microsoft, was in the top 10 years ago. Apple, 2.1 trillion. Aramco, Microsoft, that's the only one that has done 2 decades. Amazon didn't exist in the top 10. Google didn't exist in the top 10. Facebook, Tencent, Tesla, Alibaba, Berkshire Hathaway or Warren Buffett were not in the top 10. Will they be in the top 10 in the next decade? Don't be so sure, according to Ruchir's research. So why do these giants stumble? Ruchir, if you could take us through this this description. You say they sow the seeds of their own demise.
Yes, that's correct. This is the laws of creative destruction, which is that the companies which are great today, which are seen to be doing really well, very, very few of them tend to do well after they become extremely large, because then they are not that nimble, they are not that innovative, they're not able to cater to increasingly local tastes because they become so centralized, and so therefore they begin to falter. And also because consumer tastes change, consumer habits change. So it's really fascinating that we had a tech boom in the 1990s, and just like you showed in that table of the top 10 companies in the world, today 8 out of the top 10 companies in the world are in some way tech oriented companies. We had a similar instance in 1999-2000, and of those 8 companies which were there in the top 10, which were new age tech companies, Microsoft is the only company which is still there today. So many other companies which were in the top 10 of that era, the Ciscos of the world, Nokias of the world, they've all become much smaller companies today relative to these new giants that have emerged. So that's what really happens. So if I were to put any capital to work, I would not invest in any of these top 10 companies today, because I think that in the next 5 to 10 years, their growth rates are bound to slow down and even disappoint from the very inflated levels that we are here. And also because new challenges are rising very rapidly. New challenges which are more local in nature, that are able to cater to more local domestic tastes, are more nimble. They're rising very rapidly. There's a Shopify coming up, to almost challenge Amazon. There are baby Amazons coming up in different parts of the world, like in places like Poland, in places like Southeast Asia. You have these baby Amazons that are coming up, which are much more local in nature, and therefore able to give Amazon a much greater fight than would have been the case 5 or 10 years ago. So this is the laws of creative destruction as to the rise of the challengers and how these incumbent giant companies are once again showing signs of slowing down. So the user growth that you see is slowing down of these giant companies. So yeah, today they appear invincible, but in every which way the pressure on them is increasing, including increased regulatory pressure. And over the next 5 to 10 years, if I were a betting person, I would say that these companies will fade rather than grow rapidly from here.
That's amazing, because you're right. It is like we all think they're going to be here forever. They're the big new thing. But your history shows from 2,000% in one decade, they go down to just 65%. And now moving on to your last top 10. and I almost wanted to censor this. You said end of television, but then fortunately you said except in India. That's what your data showed. Otherwise you would have written us off as well. Fortunately, that's not true. But there is a US decline in TV viewership, and that's very sharp according to you. If you look, except for the Trump bump in news, you call it the Trump bump. Look at that. Since Trump came in, news viewership shot up from 6% to around about 16%. But that was not enough to, could not save all of TV. Well, of course, entertainment, sports, etc. And look at that decline. Is now, minus 20%. But what about India? Has there been a drop in television viewing in India? You remember, this would have been censored if you had the wrong data here. But look at that. There's been an increase in television viewing over the last 2 years in India, 7%. But there has been a faster, much faster increase in video streaming of 130. This is paid video streaming like Netflix and others. 136%. Catching up, but there's no decline like you see in television as you see in America. And why is this happening, Ruchir?
Yeah, so I think that as far as America is concerned, like the experience is shifting more and more to watching television that you really want in a non-linear way, sitting at home, and I think that's a trend that's been accelerated by the pandemic. So I think what this pandemic has done in many ways, Prannoy, it has accelerated many trends that were already underway. That's been for me the one feature of this pandemic. So we have moved much more to streaming. Even theatrical viewing has been declining in America very significantly over the last 20 years. In fact, the box office ticket sales are down by 1/3 over the last 20 years in America. So we are seeing this trend where people are moving away from going to the theater and watching television in a linear way, and there's much more content now which is coming online, and people are watching it in a far more curated way. So I think that what is going to happen after the pandemic is that so much of life is going to obviously come back to normal. I think the buzzword may shift from work from home to return to normal, from WFH back to RTN. But I think that for a few trends, they're likely to outlast the pandemic. And the decline in TV viewing, decline in theater viewing is something which I think is going to continue. And once again, I always look to China these days to see what's the future, because in China, where life is pretty much returned to normal following the pandemic, you find that on most counts, things, for example, if you look at travel, it's back to exactly the levels it was before the pandemic. Domestic travel, restaurant bookings, back to exactly where you were before the pandemic broke out. But theatrical viewing is down, still down 20% from where you were before the pandemic broke out. So I think that these structural trends are underway with TV, theater, that viewership declining, and in places like India too, I think that TV is just about holding up, but my suspicion is that very soon in India too, the same trend is likely to play itself out, given the extremely sharp rise we are seeing now in OTT platforms.
Wonderful, Ruchir. Wonderful, wonderful clarity in your top 10s. Thank you so much. We'll end now. It's amazing that you say to look ahead. You look at China, and we learn a lot. The whole world learns from China, and not from America, except that you're seeing a return to democracy in America. Maybe the world will learn something from that. But thank you very much, and we leave you all with Ruchir's top 10. Here they are. And that's all for now. All of this is available on our website, ndtv.com, if you want to catch up with anything. But Ruchir, thank you again. God bless you.
Thanks, Prannoy. Really appreciate it doing this show. Thank you.